Welcome back to Investing Talk Podcast.
Today we're looking at intuitive machines.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When we look at intuitive machines, what stands out immediately are these two massive strategic moves that management made this past August.
Yeah.
And these aren't just, minor corporate actions. They fundamentally reshaped the whole investment thesis.
They really do. It moves the company from being, a pure play lander developer
Exactly.
to a much more diversified space services provider.
That's the perfect way to put it.
So that first strategic pillar, we have to unpack the acquisition of Kinetics. This move tells you that management isn't just satisfied with being the space delivery guy.
No, not at all. They want to build a deep, defensible moat.
Right.
So in early August, they acquired Kinetics, and this company specializes in two very technical areas: autonomous spacecraft navigation and, crucially, proximity operations.
Okay, and the price tag was, around $30 million?
About $30 million, yeah. A mix of cash and stock. But honestly, the value here is in the capability, not the transaction size itself.
Let's focus on those capabilities then, because for the average investor, autonomous navigation sounds good, but what does it really mean for the bottom line?
Yeah, how does it translate into revenue?
Exactly. How does it build those defensible revenue streams that we're all looking for?
Well, it changes their entire business model. I mean, think about their original core strength.
Landing things on the moon.
Right, which is incredibly difficult, don't get me wrong, but it's essentially a one-time delivery service.
Mm-hmm.
By adding Kinetics's expertise, they can now perform services after the landing or even during transit, and all without direct human intervention.
So proximity operations means what? Like orbital maneuvers, rendezvousing with other craft?
Exactly that. Refueling, deploying complex sub-payloads.
So instead of getting paid just one time for a successful landing, they start to build out this potential for recurring revenue. Yeah. From in-space servicing, maintenance, complex assembly, things like that.
Precisely. This is the difference between being a taxi service and, say, being the general contractor for a lunar construction site.
That's a great analogy.
It allows them to participate in these lucrative, long-duration missions. Think space station assembly or deep space resource surveying. The technology required there is incredibly sticky.
And if you integrate that Kinetics software into their landers, the switching cost for a competitor to provide that same level of integrated service just goes way, way up.
It goes way up. It signals a very clear strategic priority. They're using their capital to buy growth and expand their technical mastery.
And that leads us perfectly into the second strategic pillar, which is how they funded this entire growth push.
Right.
Because when you look at the financials, specifically that capital raising event in mid-August, it really confirms that the market agrees with this direction.
Oh, it absolutely does. This was one of the most compelling pieces of data we've seen from them recently.
So what did they do?
The company executed a massive private offering. They raised an aggregate principal amount of $345 million.
Wow.
Through convertible senior notes that are due in 2030.
$345 million. That is a huge injection of liquidity for a company at this stage. But the detail that, analysts were really buzzing about wasn't just the amount, it was the terms.
Yes.
Raising that kind of money with an exceptionally low 2.5% coupon rate. I mean, that's a phenomenal vote of institutional confidence.
It's the ultimate market endorsement. If you strip away all the financial jargon, the convertible note is basically a delayed trade-off.
Okay, explain that.
The company needs cash now to scale, right?
Yeah.
And investors are willing to give them that cash at a very, very cheap interest rate, that 2.5% coupon, in exchange for an option in the future.
So let's break down that option piece because it's so critical for understanding both the bull case and, the dilution risk we'll talk about later.
For sure. Think of it like this. The company borrowed $345 million for just 2.5% interest. That's way cheaper than bank debt. But the note holders have the right to convert that debt into common stock. If, and only if, the stock price rises above a certain predetermined level. That's the conversion premium.
So if the company executes well, the stock goes up, the note holders convert their debt into equity.
And the company never has to pay back the principal in cash.
That sounds like a dream scenario for the balance sheet. They raise capital cheaply and then pay it off with stock appreciation.
It is, but
what if the stock doesn't appreciate?
Then they have very low-cost debt, but they eventually have to pay back that $345 million in cash. or they're forced to convert at less favorable terms.
So there is risk.
There is. But the key takeaway from that low 2.5% rate is that investors are betting heavily on the success scenario. They're betting the company will grow enough to make that stock conversion way more valuable than the low interest they're getting now.
It gives them an incredibly long and comfortable operational runway. I mean, a multi-year cushion to fund the KinetX integration, scale up operations, and execute their mission pipeline.
All while preserving optionality for existing shareholders. They've secured the capital to run their hypergrowth playbook.
And while we're on dilution, the increase in share count from the KinetX deal was pretty modest. Right?
Oh, very modest, just a small uptick in the overall share base. The benefit of acquiring those technical capabilities far outweighs that minor short-term dilution.
The bigger dilution question comes later with the notes.
It does, but that's a function of success, really.
Let's pivot now to what I think is the most compelling part for anyone looking at space tech, the competitive landscape.
The moat.
Exactly.
Yeah.
Given these strategic moves and all this new capital, what is their competitive moat, and how do they defend it against the giants?
Well, the primary moat is built on, I'd say, 3 layers. First, they have demonstrated operational capability with their own proprietary lunar lander tech. Actually landing a vehicle on the moon is the ultimate proof of concept. It's not a drawing on a whiteboard. It's a tangible achievement.
That proof of concept is the biggest barrier to entry in this sector. You can have the best blueprint in the world, but if you haven't actually succeeded in the gravity well, you are years behind.
You're years behind, correct. The second layer is their status as a NASA-selected provider.
Which is more than just a badge of honor.
Much more. It implies long-term government contracts. And those contracts provide massive revenue visibility, stability, and, again, high switching costs. NASA has invested in this company. They're not just going to switch vendors for delicate scientific payloads.
That stability must be a crucial firewall. Because when we talk about competitive pressure, we have to talk about the elephant in the room.
SpaceX and Blue Origin.
Right. Starship offers potentially massive, low-cost transport. How does a company like Intuitive Machines compete with those behemoths?
That is the critical question. And for now, the answer really lies in specialization and market scope. Starship's promise is mass, heavy lift transport. It's focused on Mars, or, very large lunar-based components. Intuitive Machines is optimized for the other end of that spectrum.
Precise, highly customized, small to medium payload delivery.
Exactly. And the complex integration for scientific missions and those initial commercial missions.
So they're focusing on the niche of scientific instruments, that delicate maneuvering, and the complex proximity ops they just bought with KinetX. They're not competing on sheer tonnage.
Precisely. Look, the market is vast. We're talking about lunar resource extraction, establishing communications networks, deep space astronomical platforms.
Government science missions.
All of it. It's too big for one company. And the consensus suggests that their specialization, especially their proven ability to handle that last mile of lunar logistics, it allows them to coexist even alongside Starship.
You could even see a scenario where they're complementary.
You could, riding along on a larger launch vehicle and then handling the final precise deployment.
That provides a really strong mitigation, viewing them as specialists rather than just pure mass competitors.
Yeah.
But let's flip the script. Every growth story has dangers. What are the top 2 risks investors have to be mindful of here?
The number one risk, bar none, is execution risk on the lunar missions themselves. Space is still an incredibly hostile and complicated operating environment.
Yeah, we've seen enough spectacular failures to know that success is never, ever guaranteed.
Right. A lunar mission is the ultimate binary event. A failed mission doesn't just damage hardware. It would significantly delay revenue recognition.
It would crush customer trust.
Severely compromise it, especially with NASA and commercial clients who have high switching costs but demand absolute reliability. And it would, without a doubt, hammer the stock price. It's the single biggest operational threat to the bull thesis.
Okay, and the second major risk, it brings us full circle back to the financing structure we talked about.
Dilution.
Dilution. Specifically, the risk tied to that $345 million in convertible notes.
Correct. The convertible note structure is a fantastic tool, but it is still a massive potential equity overhang.
So if the company fails to execute,
and the stock price stagnates or underperforms, those note holders might not be able to convert at that desired premium. But the notes still mature.
and when they mature,
The company will have to issue a large volume of stock at a lower conversion price than they hoped, or pay the principal back in cash, which would really strain their liquidity. Either way, it causes significant, unexpected dilution for existing shareholders.
It's that classic high-growth dilemma, isn't it?
Yeah.
You take on dilution risk today for a shot at massive growth tomorrow.
That's the trade-off. But like we said earlier, that extremely low 2.5% coupon rate suggests the market expects them to mitigate this risk through massive growth.
If the growth materializes, the earnings increase will hopefully far outpace the impact of the dilution.
That's the calculation. Institutional investors aren't lending money that cheaply unless they're highly confident the growth will be there and the conversion premium will be met. It is a calculated gamble on execution.
All right, let's talk timing. For an investor looking at a position today, what are the near-term catalysts we should be monitoring over the next few months? Say, late Q4 2025 into Q1 2026. What are the signposts that tell us they're executing?
First, we have to watch the upcoming earnings report. The Q4 2025 earnings, which usually come out late January or early February 2026, will give us fresh guidance on the 2026 mission pipeline.
And updated financials post-acquisition. That guidance is critical.
It is.
I'd also be watching for new contract announcements, particularly any new lunar mission partnerships beyond that initial NASA framework.
Yes, validation from new commercial entities would signal that the commercial lunar economy is really starting to move.
And we'll need specifics on the KinetX integration. We want to hear management talking about synergy realization. Are they successfully cross-selling the autonomous navigation?
Are they booking contracts that leverage the combined entity? Good M&A execution is just as important as the acquisition itself.
And finally, we can't forget the macro environment. Q1 2026 is often when the U.S. government space budget discussions really ramp up.
Right.
Any significant shift in federal priorities toward lunar or deep space infrastructure could provide a major tailwind that's not even company-specific.
Taking all these elements together, the capital they've secured, the strategic expansion into advanced services, and the inherent risks. This is absolutely not a short-term trade.
No.
This is best viewed as a multi-year hold, probably a 2 to 3 year time horizon. That allows the company time to execute on their mission pipeline and really capitalize on the structural growth of this emerging commercial lunar economy.
So, to sum all this up, Intuitive Machines is strategically positioned at the convergence of commercial lunar logistics and a renewed government focus on deep space exploration. They have the capital runway secured through that exceptionally favorable $345 million convertible offering. And they've used smart M&A to acquire critical autonomous navigation tech.
Effectively widening their technical moat beyond just being a lander provider. They have the strategy and the capital required for their next phase of growth. The long-term upside is substantial, provided they successfully manage the high operational risks inherent in space travel.
The big question for you to mull over until our next analysis is this. Given the massive capital injection and that expanded technical moat, does Intuitive Machines have enough runway and specialization to make their first mover advantage permanent? Or will the sheer scale of giants like SpaceX eventually make their niche irrelevant?
An exciting puzzle. Make sure you subscribe to Investing Talk podcast for our next analysis, and we look forward to seeing you in the comments.